The investment strategy that actually builds wealth has one major flaw. It's boring long before it looks brilliant. At first, almost nothing happens. You open the account, you buy the index fund, you automate the contribution, then you wait. 1 month passes, the number barely moves. 3 months pass, and there's still nothing dramatic to report. A year passes, and the account is higher than before and just not enough to change your life or impress anyone or feel like proof the plan is working. Meanwhile, someone online turns a small stock position into a huge gain. Someone else claims they made a month's salary trading options in an afternoon, and suddenly the boring strategy starts to feel less like discipline and more like quietly falling behind everyone else. By the end of this video, you'll know exactly why that feeling is the trap, not the warning sign it seems to be. You'll see the real data on why investors underperform their own funds, and why boredom specifically is one of the quiet engines behind it. And you'll get a simple way to tell the difference between a strategy that's failing and a strategy that's just working exactly as designed. Compounding doesn't fail because it's boring. It works because it's boring. Those are two very different statements, and only one of them is accurate. Human beings aren't naturally built to trust slow systems with delayed feedback. We like visible progress. We like a story. We like checking something and seeing it move. But the strategies most consistently backed by the data, low-cost index funds, dollar-cost averaging, buy and hold, don't feel powerful while you're actually doing them. They feel like nothing. And nothing is one of the hardest things a person can keep doing on purpose month after month for years. That's why a lot of investors don't lose because they picked a genuinely bad fund. They lose because they quit a good strategy during its boring stretch. DALBAR has tracked real investor behavior for decades. Its 2025 report found the S&P 500 returned 25.02% in 2024, while the average equity fund investor earned 16.54%. That's still a solid year on its own terms, but it wasn't the market's actual year, and the market offered more, and a lot of investors simply didn't collect all of it. The following year told a different story. DALBAR's 2026 report found the S&P 500 returned nearly 18%, while the average investor earned 17.16, a gap under 1 point. Morningstar found something similar in its own research. Over the 10 years ending December 2024, the average dollar invested in U.S. mutual funds and ETFs earned 7% annually. The funds themselves returned 8.2% over that same decade, a 1.2 percentage point gap compounding quietly year after year without most investors ever noticing it happening. The cause isn't mysterious. Money tends to arrive after a strong run has already made an investment feel exciting and tends to leave once it turns painful or disappointing to hold. Investors buy after the story gets fun and sell after the boredom or the fear becomes unbearable. That's the behavior gap. Boredom is one of its quietest, least discussed engines. Here's how real compounding actually looks compared to how people imagine it. Most people picture a rocket launch, the curve bending upward almost immediately, the future obvious within a year or two. Real compounding starts closer to flat. Invest $500 a month, and after 5 years, you've personally contributed $30,000, with market growth adding a few thousand more on top of that. Most of the balance at that point is still money you physically put in yourself. The portfolio isn't carrying you yet, it's barely helping, and that's genuinely discouraging to watch happen in real time. So the brain starts asking a dangerous, deceptively reasonable-sounding question: is this even working? That question often shows up right before the system is actually about to start mattering. Compounding has a delayed personality. For a long stretch, it whispers. Then, at some point that arrives later than most people expect, it starts speaking considerably louder. At $5,000, a 10% return is $500. Nice, but not remotely life-changing on its own. At $50,000, the same 10% is $5,000, starting to feel genuinely meaningful, not just theoretically nice. At $500,000, that same percentage is $50,000. More than many people manage to save from their own income in an entire year. Same percentage every single time. A completely different felt experience purely because the base underneath it grew large enough for the math to finally become visible. This is exactly why the early years are so psychologically dangerous. The strategy is working mathematically well before it's working emotionally. And if you need emotional proof too early, you may quit before the math gets loud enough to convince you. This is where the exciting strategies become genuinely seductive. Day trading gives constant feedback. Stock picking gives you a story you can tell. Trend chasing gives you something to watch move in real time. But here's the uncomfortable part underneath all of it. The excitement and the risk are frequently the exact same variable, just viewed from two different emotional angles. The reason a fast-moving position feels alive is precisely because it can move violently in either direction. The reason it gives you a jolt is because real money is exposed to real, fast uncertainty. A broad index fund doesn't give you that rush. It doesn't let you say you found the next big thing before anyone else did. It simply owns a wide slice of the market and waits. That can feel unsatisfying because it quietly removes the main character from the story, you, and most people secretly want their investing to confirm something about their own judgment. But long-term wealth tends to reward a different identity than the confident predictor. It rewards the repeatable person, the one who keeps buying when it's boring, and again when it's mildly uncomfortable. This is exactly why dollar-cost averaging works so well as a behavioral system, not just a mathematical one. It means investing a fixed amount on a fixed schedule, regardless of how the market currently feels. It doesn't guarantee a profit. It doesn't prevent a loss. What it removes is one of the most dangerous questions in all of investing. Is right now the perfect moment to buy? That question sounds intelligent when you ask it. In practice, it usually becomes a trap because waiting for certainty about market timing can mean waiting for a moment that never actually arrives. Markets feel too expensive when they're rising. They feel too dangerous when they're falling. They feel confusing and directionless when they're moving sideways for months at a time. So the boring system quietly answers the question by refusing to ask it every month. Automate the contribution, buy the fund, and let time do the slow, mostly invisible part of the work. There's no daily drama in an automatic transfer, but that's precisely the advantage. A strategy requiring fewer ongoing decisions creates fewer chances for emotion to rewrite the plan halfway through. The wealth isn't only sitting inside the fund itself, it's built into the system that prevents a person from interrupting the fund every time the news cycle gets loud. Every single year will hand you a fresh reason to interfere. A recession warning, a market high, a sudden crash, a headline explicitly designed to make patients feel irresponsible for holding on. But once money is truly long-term, the real question becomes simpler. Can that money be allowed to actually behave like long-term money? Even when the account drops or goes flat for 18 months straight, that's when boredom quietly turns into temptation. A slightly better sounding fund, a hotter sector, a little trading on the side, or just moving everything to cash until things make more sense. Every one of those tweaks feels small and reasonable in isolation. But a career's worth of small tweaks can quietly turn a genuinely good plan into a mediocre outcome, one minor interruption at a time. This is why boredom deserves an honest rebrand here. It isn't proof the strategy is broken. It may be proof the strategy is finally protected from your own worst instincts, at least for the moment. If the account is diversified, reasonably priced, matched to your actual time horizon, and funded automatically, boredom is frequently exactly what a working plan is supposed to feel like from the inside. It means there's no live crisis to solve, no prediction currently required, and no manufactured emotional emergency demanding an immediate transaction be made on its behalf. By the time compounding finally does become visibly exciting, the most important work is already long finished. The early contributions, the flat months, the years where nothing appeared to be happening at all. The decision not to quit. The decision not to chase whatever was performing best that particular quarter. The decision not to confuse constant activity with genuine progress being made underneath it. That's where the actual wealth got built. Not in the exciting bend of the curve everyone eventually sees, but in the long, flat stretch beforehand, where most people quietly got bored and walked away first. So if a long-term plan currently feels boring, ask a better, more specific question. Is it boring because it's neglected, or boring because it's simple, diversified, automated, and built to outlast your own emotions? Those are two very different kinds of boredom. One is neglect wearing a calm expression, the other is discipline. And discipline often feels like absolutely nothing while it's doing its actual job. The investment strategy that gets boring before it gets rich was never broken to begin with. Getting boring was never a bug in the plan. It was the plan, working exactly as intended the whole time. Keep thinking. Stick.